What's going on, everyone? It's Phineas and welcome back to the channel. Today, we're diving deep into the world of Canadian dividend ETFs. Specifically, we're going to break down the top 3 contenders in the game right now, helping you figure out which one might be the perfect fit for your portfolio. Now, before we jump into the nitty-gritty, let's set the stage with our selection criteria. We're focusing on ETFs that hold Canadian companies listed on the TSX, boasting those juicy high dividend yields, think above 3%. We also want passive management to keep those fees low, a low MER overall, and of course a history of positive long-term growth. Gotta make sure those dividends keep flowing, right? So if you're ready to explore the exciting world of passive income and watch your money make money, buckle up, smash that like button, and let's get started. First up, we've got XDIV, the iShares S&P/TSX 60 High Dividend Index ETF, managed by BlackRock. Now this bad boy is currently trading at around $28.53 per share. One thing to keep in mind with XDIV is its sector allocation. It's got a hefty 46.56% exposure to financials and another 31% to energy. Now this isn't necessarily a bad thing, but it's something to be mindful of, especially if you're aiming for maximum diversification in your portfolio. But hey, let's talk about the good stuff. Those dividends. XDIV boasts a trailing yield of 4.4%, which is pretty sweet. And if we look at the distribution yield, it's even better at 4.76%. That means for every $100 invested, you're looking at around $4.76 in dividends annually. Not too shabby, right? And the cherry on top, a low MER of just 0.11%. That means more of your money is working for you and less is going towards fees. Next up, we've got XEI, the iShares S&P/TSX Composite High Dividend Index ETF, also managed by BlackRock. This one's currently trading a bit lower than XDIV, sitting at around $24.91 per share. Now, what sets XEI apart is its commitment to diversification. Unlike XDFOI, which leans heavily on financials and energy, XEI spreads the love a bit more evenly. Its top sectors are financials at 30% and energy at 29%, providing a bit more balance. But hold on, it gets even better. XAI takes the crown when it comes to dividend yield, boasting an impressive 5.79% trailing yield and a 5.24% distribution yield. That's right, you heard it here first, folks. If you're looking for maximum passive income potential, XEI might just be your new best friend. However, keep in mind that its MR is a touch higher than XDIV, coming in at 0.22%. Still very reasonable, but something to consider nonetheless. And last but certainly not least, we have my personal favorite, VDY, the Vanguard FTSE Canadian High Dividend Yield Index ETF. Now, this one's currently trading at a premium compared to the others, sitting at around $44.85 per share. But trust me, there's a good reason for that. VDY holds a basket of Canadian companies with a history of paying out those sweet dividends. Similar to XDIV, VDY has significant exposure to financials at 55.1% and energy at 30.3%. But what sets VDY apart is its performance. We're talking a solid trailing yield of 4.08% and a distribution yield of 5.27%. But it's not just about the yield, right? It's about consistency and growth. And let me tell you, VDY delivers on both fronts. Since 2012, this ETF has consistently delivered long-term returns of around 10%. That's the kind of performance that gets me fired up. So there you have it, my top 3 picks for Canadian dividend ETFs. Now, full disclosure, I don't actually hold any of these in my portfolio right now. Why? Well, at this stage in my investing journey, I'm laser focused on growth ETFs. But as I get closer to retirement, you can bet I'll be shifting gears and adding some dividend-paying powerhouses to my portfolio. Remember, diversification is key. Don't put all your eggs in one basket, especially when it comes to investing. And when you're ready to start building your dividend portfolio, do it the smart way. Use those registered accounts like your TFSA or RRSP to shield those sweet dividends from the taxman. And one last piece of advice. Don't treat dividend ETFs as a get-rich-quick scheme. They're just one piece of the puzzle. Do your research, invest consistently, and watch your wealth grow over time. Until next time, happy investing.